us all shout. There's one man we're watching, his moves full of clout. Some call him evil, some call him foul, but I just smile and call him Daddy Powell. Will Jerome Powell nuke the market again? With a flick of his wrist, make fortunes disappear in the wind. Wall Street's a jungle, lions on the prowl, but the king of the jungle is old Daddy Powell. Oh, Daddy Powell. Oh, Daddy Powell. Every single time, it's like a fucking roller coaster ride. It's gonna be a crazy week, so hold on tight. Oh, Daddy Powell, don't bring me down. The numbers are flying, red ink and green. For some it's a nightmare, for others a dream. Degens are crying, theories disavow, all bending the knee to mighty Daddy Powell. Oh, Daddy Powell. Oh, Daddy Powell. Every single time, it's like a fucking roller coaster ride. It's gonna be a crazy week, so hold on tight. Oh, Daddy Powell, don't bring me down. Oh, Daddy Powell. Oh, Daddy Powell. Every single time, it's like a fucking roller coaster ride. It's gonna be a crazy week, so hold on tight. Oh, Daddy Powell, don't bring me down.
Oh, brother, oh, brother, oh, brother. Good afternoon, good afternoon, good afternoon. Welcome back to a specialty episode of the Matt Kohrs Show. And with songs / intros like that, could you imagine watching the market in any other show? All those fucking dweebs out there who have no idea what they're talking about. They don't bring on some of the best guests, and they definitely don't have the best music. Blows my mind, but hey, you can lead a horse to water, but you can't make it drink. Folks, I hope you had a great morning. I hope you had a great lunch, and we are here waiting for the FOMC Fed interest rate decision, where they're going to announce that we have a 25 bips rate cut. We all know that's happening. What's interesting, and what's either going to send the market to the moon or all the way down to Valhalla, is going to be any commentary about quantitative easing / tightening and really what they're doing with the portfolio runoff, and also any indication of what the path forward might be looking like. So that's what we're going to be. Not only at first, the result comes out at 2. We're going to be getting into the breakdown. There's no dot plot this time around, the SEP, the Summary of Economic Projections. So that's not happening this time around. But obviously there's going to be the press conference at 2:30, and we're going to be here for the whole thing. I hope you guys are ready. I hope you guys are prepared. I hope you guys have your socks on so we can knock them off. And I guess before things get too wild, let me do this quick. Shout out to Funded Futures Network, FFM, for partnering up on this show. Just so you guys know, this whole 50% off BOGO activation fee deal, it ends on Friday, the 31st. This deal ends this Friday, so you don't have that much more time to take advantage of it. Once again, with that code Goonie, you get 50% off the eval. When you buy one, you get one as well, so you're getting two for 50% off, and there's no activation fee. So I just want to call that out, that it ends this Friday. It's pinned to the top of chat. It's in the description of the video. Check that out. And then for anyone curious about my positions, to be completely honest with you, I'm a degenerate. So I had to shut it down because I know myself, and I know that if I left this open, if I left my NinjaTrader platform open during this FOMC event, I would be way too tempted to trade. So sometimes when you have an addict, you gotta take the meth pipe away. And that's what I did for myself. I shut the program down, so I can't show you the program, but obviously I took a screenshot of it and put it out there. You could see my PA accounts. You could see how much I made. I made about $1,600 per account, so I made about $32,000 across these 20 accounts, and then I made an extra $500 on the FFN accounts, which this one officially passed, and this is the other one that we're doing the video on. So for me personally, I just had to shut it down. I know that at some point past 2 p.m., I'd be like, I think I see this opportunity. I think I see something going on that I really want to take advantage of. I would just be too tempted. I would simply be too tempted. And when the accounts are all pretty much up $8,000-$9,000 already on the 20 accounts, I have the worst track record of going on a good run and then FOMC messing me up. So I'm already on this good run. Let's take myself out of the equation. I made some good trades, made some good money, and it's just not worth it. You know, even if we doubled up, even if I ran these up to 3.2K per account, that upside reward not necessarily worth the risk of blowing it all out. So right now, I'm just not liking it. I'm not liking the paradigm, and I know myself. I know I would really talk myself like I can really convince myself of some crazy stuff. So I just, knowing myself, need to take a step away. So I already locked into trades. I already made the money. I posted it not long ago, 10 minutes ago, and I just got to call it on the day. And, you know, if I see some good swing opportunities, like for my swing options account, I might take that. But in terms of active day trading, swing trading, not my cup of tea today. Anyway, this is where we're at the market. The SPY is slightly below yesterday's high, hitting a new all-time high today. The Qs are slightly above the high from yesterday, hitting a new all-time high. VIX, even though the market was high, VIX also popped. So the VIX is giving us some weird signals. The Russell is actually looking strong, which is a little bit of a bummer for me. Gold had a good overnight session, but getting hit throughout the intraday session today. So we have a lot to pay attention to, a lot to chit-chat about. And we're going to see how this all really plays out. So I want to let you guys know that you can check this yourselves, whether you want to look on Polymarket, Call Sheet, or even the Fed Watch tool. I'm way too zoomed in, golly. You can see right here, 97.8% chance that we go from the current rate of 4% down to 3.75. That's what's going to be going on. It's going to happen. Not only is the Watch tool saying this, Call Sheet is saying this, Polymarket is saying this. We know we're getting a 25 bips rate cut. And in fact, the market's actually really confident that we're going to get another 25 bips rate cut in the December meeting. There is no November meeting. The question is, what's happening after, specifically January, March, April? This is where, in terms of where we're going with the Fed rate, the market is going to be listening to every word Jerome Powell has to say. And January, March, that's going to be the big ones, because remember, after that, May is when he's done. So April will be the first meeting with a new Fed chair. So really, we're saying what in the world's happening in January and March. That's what we want to know. So very, very important. Pay attention to that. Also, quantitative tightening. That's going to be more for, I suppose, the part of today's show where he's doing the interview. So remember, it comes out at 2. There's the market reacts. Then we have an awkward half hour where the market's doing whatever, and then he starts talking, and then the market reacts to that. So on FOMC days, there's 3 major parts. Market open till 2 p.m., 2 p.m. till 2:30. That's the awkward initial reaction just to whatever's in the written thing. And then 2:30 to market close is the market reacting to everything, including the press conference. So we have a lot to pay attention to, but that's pretty much the schedule. And we have about 3 minutes to go. Right now, the SPY, everything's slightly green right now. The SPY, the Qs, and the Russell. Actually, the Russell's up a decent amount. My question to all of you, what's the guess? Where do you guys think we are going today? And I'm asking you now, and you have to answer now, because if you answer later, it's cheating and you're already going to know. So before we know the actual results, do you think we are about to go sky high? Do you think we're about to go floor low? Do you think it's going to be a giant fake out? Basically, I'm saying by the time the bell goes ding, 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 ding to wrap up the markets on the day, 4 p.m., where do you think we are going to be? Way high, way low, or pretty much at this level? Steven, you are looking for the gap fills. Collapse the gaps. Red, flat, only up, down to Chinatown. Up and away. Zero. Down today, up tomorrow. Pop, then reversal. Down. Undecided candles. Moon and Mars. Blast off. Up and down. Super up. You guys are pretty much 50-50. Pop, then drop to the gaps. Down, then up a lot. Oh, you guys are way undecided. You guys cannot come up with an opinion on this one, can you? You cannot come up. Wow. You guys are all over the map. Sell the fact flat. Megan. You know, you could always bet on Megan. I'm getting high now, Mateo. Jay Hundo ripping a fat one just to deal with Powell. Hey, we've all been there. We've all been there. All right. Well, I better open up a brokerage over here just in case I have to do some of my swing positions. Okay, let's get ready. Let's get ready for the big one. You know what's awesome about days like today is we get to hear our boy Rick Santilli. We get to hear our boy Rick Santilli, that beautiful man. All right. Options. Orders. And positions. All right. We're in. We are in. I am ready to rock when need be. Golly. I'm ready to do this. I'm ready to do it. All right. Well, we are officially 1 minute out, which means let me get this up. Fed meeting live updates. Traders expect a rate cut, but are eager to hear what may come next. You and me both, brother. Hey, folks, if you haven't already, before we start to do all this, if you guys could do me a massive favor and take a quick second to hit that like button. As you guys all comment something and like something, it drives up engagement. When there's more engagement, it promotes this video to more and more people. So if you quickly want to spam your bet on what's going to happen, if you quickly want to hit that like button, and if you haven't already, hit that subscribe button, all of that stuff. If you want to help me out, if you don't want to help me out, that's cool too. I'll go fucking kick rocks somewhere. But if you do want to help me out, I would ask that you kindly like, comment, subscribe, turn on those notifications. And with that being said, let's see what our boy Rick has to do.
To get a core read, especially on the inflation side. That's really
the volume is very low.
And tell us where we were 3 months ago. So I want to hear from Powell today. This is what we're going to be looking at, not just how we're going to be reacting to the economy ahead.
Here we go.
Now, Francis, one quick point here before we get to that decision. From a data standpoint, do you feel constructive about what the economy is doing right now as we head into this?
Did it not come out? Oh, up? 6 points up?
No,
3 points up?
This is what we call stagflation light type of environment. It is growth below comfort
no
level.
Reaction.
And it is certainly inflation above comfort level.
Is it not out?
I don't know what the Fed's trying to achieve with these rate cuts here. Maybe
First
not being
one,
as
very
restrictive.
okay,
but
there
a lot
we
of the
go.
job weakness that we've seen is that low hiring, low firing results from a
All
trade
right.
shock that's
A little
coming
bit of a
through.
delay
I'm
there.
not sure that these
Awkward.
rate cuts that we're seeing from the Fed is going to cure what ails the American economy.
All right, Francis, hold it right there. Let's get out to Steve Leisman for the big Fed rate decision. Steve.
Muted.
The Federal Reserve cutting interest rates by a quarter point to a new range of 3.75 to 4%. There were two dissents on this. The second one by new Fed Governor Myron, who wanted 50. First one by Kansas City Fed President Jeff Smith, who wanted no change. So dissents on both sides, a kind of a rare occurrence for the Fed. The Federal Reserve announcing it is stopping quantitative tightening or the roll-off of its balance sheet as soon as December. All roll-offs of treasuries from here on out and mortgage-backed securities on the Fed's balance sheet will now be invested into
shrinking balance sheet on December 1st.
It's a bit of a change there. On the economy, the Fed said economic activity expanded at a moderate pace, according to available indicators. One of two nods in the statement to the absence of data by the Federal Reserve. It had said in September that the economy was moderating, so almost a bit of an upgrade to the economy, but according to available data. Job gains, it said, has slowed, however. Unemployment remained low through August. And again, it said more recent indicators are consistent with these developments. That's another nod to the idea that the Fed doesn't really have the official data. More recent indicators is what it's using. Inflation, it says, has moved up since earlier this year and remains somewhat elevated. That is the same characterization as September. And there's not much in the way of forecasting the future path of rates. I believe that'll have to wait for the press conference from Fed Chair Powell. But again, the Fed cutting by a quarter, two dissents on both sides of the issue. One wanted more, one wanted none at all, and the Fed stopping quantitative tightening as of December. Guys,
that's crazy.
All right, Steve Leisman, please stick around here. Let's get back to our panel for some reaction here. Jim, I'm going to start with you first. We showed the charts of the market reaction. Equity markets have been relatively stable as they were going into this print. The curve from the 2-year all the way to the 30 have moved maybe higher by anywhere from what I could see 1 to 3 basis points. This is all about the Fed rate press conference now at this point. But what stood out to you from hearing what you heard from Steve and then what you saw or didn't see from the market reaction?
So that's a great question. So I think that we are in the sweet spot of policy uncertainty for markets. And what I mean by that is that we're expecting there to be better growth in 2026. But at the same time, we're also expecting the Fed to cut interest rates. So you may have higher growth. You may have a labor market which is keeping wage inflation and wages relatively stable,
that was a
which keeps profit margins high for companies.
Back to 6,900.
And again, better growth, lower rates. You're discounting those future cash flows at a lower rate. You're increasing the present value. And what it's doing is it's supporting valuation. So this uncertainty that's being discussed right now with the labor market and what Fed policy is likely to do and lower interest rates, equities are the beneficiary.
Okay, David, you see it all from an asset management perspective. Does this change at all anything with regard to how you view future allocations, how new client money gets put to work? What exactly does this mean in the construct of how investors have viewed what this rate decision will mean for them?
Well, I think the one interesting thing was that dissent in terms of not cutting at all from the Kansas City Fed president. I think
this is the shelf, really 6,900.
Because it does
have a quick downside to yesterday's close at 6,890.
I think the pushback isn't about the economy. I think it is about how strong markets have been this year. And if that gathers a little momentum, we may see a Fed easing a little bit more slowly next year. So maybe not heading straight down to 3%. In terms of investors here, I think it's been a wonderful year for investors, but that follows 2 great years. And I'd say rebalance. I mean, I think people just need to look at the risk side of their portfolios and not just the very strong gains that we've seen in equity markets.
Francis, you used the word, I'm going to bring it up again, you used stagflationary as part of your response to my previous question. Do you feel any differently or similarly based upon what you heard from Steve? I know that we're going to break down the entire kind of report and the press conference afterwards, but do you still feel as though this is a market that is going to succumb to stagflationary pressures in the coming months?
Well, we have the qualifier stagflation light, and that this is clearly a long way from the 1970s. But look at what the statement says. It flags exactly that scenario. We have job gains that have moderated, we have inflation that has
fresh
moved
intraday
up.
low.
And that's okay for right now because the unemployment rate hasn't broken out, the bottom hasn't fallen out, and inflation, while I would say is still too high, is not up at that 4 handle. But one of these sides of this stagflation environment is going to break, and the Fed is not going to have the same luxury middle of 2026 as it does now to play both sides of that. And even in the dissent, you can see we're getting dissent on both sides of the mandate right now. That's a real call out to that. This equilibrium that we're in, it's not going to last forever. Our view is that inflation is going to turn out to be the real problem, and heading into 2026, this Fed is not going to have the ability to point to the job market to the same extent as they have now. They're going to have to slow down here when they see inflation rising further into Q1.
Francis, at multiple points over the past few months, we've heard Fed Chair Jerome Powell make public statements to the effect or the tune of that there is no risk-free path going forward with regard to inflation and or slowing job market. So you mentioned inflation being the one that you think could be keyed upon more. What exactly is that preponderance of risk for the economy vis-a-vis the markets? Do you feel as though there is a tilt one way or the other based upon what we know or what we, I guess, don't know about the economy?
Yeah, lots in that question. And I agree that inflation is going to be the bigger part of this story. And particularly, we heard my colleagues here on this panel talk to how the equity market is the real beneficiary from this cut. When I hear equity market is the beneficiary, what I hear is upper income, higher wealth Americans are the beneficiary here. And when inflation comes into play, that's the lower income Americans that are being penalized. So what we're seeing here, this stagflation type of environment, it doesn't hit everybody equally. It really exacerbates that K-shaped economy that's in play. And what's so challenging for a Federal Reserve here and their concept of the risk-free path is that no matter what direction they go in, they will exacerbate that K going forward. And that's why at this moment, this is a market, this is an economy, this is an economics profession that's going to have to think a little bit more deeply about whether we constantly go to monetary policy to solve what are increasingly structural problems and problems that are less rate sensitive. That is at the core of the statement here today, even if it's not explicitly mentioned, which is monetary policy is not going to solve the challenges that the U.S. is facing in 2026 and beyond, and they may actually end up exacerbating it when we rely exclusively on monetary policy. Steve,
I'm going to give you the last word before we take a little bit of a break here. Steve, you're going to be one of several reporters in this press conference with Jay Powell in the span of 23 minutes here. What exactly do you think most of the questions will be tilted towards? From my perspective, it would be what exactly has the Fed been looking at over the past several weeks if we've had no data?
I think that's a big part of it. And as I said, Dom, the lack of data shows up twice in the statement.
Going on?
It's kind of interesting that the person I want to ask a question of is not at the press conference. It's Jeff Schmidt. And I want to pick up on David Kelly's idea of whether or not this dissent is part of a single act by a Fed president, or is it part of a broader movement? There are a bunch of people on the committee who have expressed concern and caution about the cutting rates. And I want to ask Jeff if he's cutting rates because he's concerned about inflation being high, or is it the shutdown? Is there a reason that you don't want to do further rate cuts at all or move policy if you're out of the if you don't have the data that you need to make those decisions? So, and I am interested in whether or not there's some caution here, because we know why Myron wants to do it. He's sort of been there and done that. But this idea of whether or not there's now somebody who will step forward and say, wait a second, maybe with this inflation rate at 3%, we shouldn't be heading forward, changes the outlook for the market. I did note that the probability of a December cut is still very high, but it's not for January. January was still around 45% last I checked. One other thing is, well, I'll leave it there, Dom.
All right. A quick couple of final thoughts from you guys. David, for you first.
Well, I think overall it does bring into question whether the Fed cuts quite as aggressively going forward. But for investors, I think the economy looks fine. It's not really to me a matter of the economy. I don't feel that the Fed needs to be cutting quite so aggressively.
Negative gamma beneath. If we start to crack this,
Jim,
we could be seeing 6,850 today.
I think that starts to turn around as we start to get into the first quarter. We get big tax refunds. The consumer's going to get a boost of capital just based on the One Big Beautiful Bill Act. Consumption 70% of GDP. I still think there's going to be economic activity. Plus all the business investment, to me, leads to a little bit, it creates some robustness in the jobs market. So I would argue that going forward, I think the Fed gets to 3.5% in terms of the policy. So December, and then maybe one more in early next year. But then I think anything after that's an insurance cut. And I don't know that they have to go beyond 3.5% at this point.
All right. And Francis, to you for the final word.
Stagflation light is going to continue to burden this central bank. There is no risk-free path ahead. And now they have no clear data either. So a challenging time to be a central banker. Focus on the fundamentals driving this market and this economy.
All right. Francis, Donald, David Kelly, Jim, Karen, thank you guys very much. All-star group here breaking it all down. And to
Dom,
Steve. Yes,
just
Steve.
real quick, Dom. We are double-checking this notion. For sure that MBS rolls over into bills. I'm trying to figure out if it's accurate that treasuries roll over into bills. It may be that coupons roll into coupons and bills into bills. We'll double check that and get back to you on that.
All right, we'll get the update from Steve on that clarification soon here. Thank you very much for your entire panel here. Let's now send it out to Chicago for reaction from the bond market and the pits out there. Rick Santelli joins us now from the CME Group out in Chicago. Rick.
Get Rick's in chat.
There's a lot of turns
Get some
and twists
Rick's
here,
going
Dom.
in
Consider
chat.
this. A 2-year was at 351 before the announcement at top of the hour. You can see that we're slightly elevated in yields, and yields were already up a little bit on the session. But here's the point. You know where they were before the last interest rate cut?
I'm not
so they
seeing
cut on
enough
the 16th,
Rick's in
they
chat.
cut today. On the 15th, the day before the September cut, a 2-year
not
closed
enough
at
because I'm not seeing thousands of Ricks in
They're
chat right
virtually
now.
unchanged.
Pay the man some
Look
respect.
at the 10-year now. Okay, the 10-year was
Put some
hovering right around
respect on his
4%.
name.
So it's a little hotter since the announcement and the rate cut. Where was it? The day before the September cut? 404.
That's my boy,
virtually
Rick.
Unchanged. The dollar index, we see that it's improved slightly, highly unchanged since the 25 base point rate cut. And the day after the 15th to 16th, when they actually cut rates, is when the dollar index made its multi-year low. So the point here is we're all talking about the Fed and cutting rates. It certainly looks like December's priced in, and Jim Carrot's probably right. Probably get one more next year. But the issue is we're all looking towards the yield curve and especially thinking about housing and the rest of the curve. But the rest of the curve is bucking the trend. We've had a cumulative 50 basis points, and basically the interest rate markets are unchanged. And since the October 1st shutdown of the government, the yield curve is flattening, which tells me there's nervousness that it's negatively affecting the economy. Back to you.
Rick, if I could just follow up here. What sense do you get from the trading community out there where you are in Chicago that the Fed is on the right path with a potential campaign or a trajectory of lower interest rates over the next several months?
Rick's sitting in a tree. Hey,
well,
you don't
they
say
like that because it most likely helps positions. But in the grand scheme of things, most sources I talk to think it's very difficult to grade what the Fed's doing because their GPS wasn't doing all that great when the government was open. The data was questionable. Now, how are they getting data? I know they put it together, and there's a lot of anecdotal puzzle pieces they're using. But in the end, my comment would be, and I don't mean this in a derogatory fashion, but I think that the grade for the Federal Reserve is C at best with my sources, and they believe that the economy is going to reheat and definitely keep the rate cut cycle to a minimum compared to what some are looking forward towards 2026.
That would be a bit bearish.
All right, Rick Santelli with the view from out in Chicago. Thank you very much for that. Now let's get a trader's take with regard to what's happening given the Fed interest rate decision, the commentary around that, and everything else we've heard from our all-star panel. Steve Grasso, CEO of Grasso Global, also a CNBC contributor, often seen on Fast Money. Take us through what your initial read has been, given what you heard about the rate story, what you heard about the commentary in there, and what you've heard from our panelists so far.
So anything less than a cut would have been a problem for the overall markets. I think that you're going to see Chair Powell is done in May of 2026. I think you're going to see 25 basis point cut every meeting that he's available to cut 25 basis points. I don't think you'll see a 50. I think that allows him to keep President Trump at bay, or criticism at bay, allows him to satisfy the markets, and allows him, just think about this, every quarter point cut, the debt is at historic highs. Every quarter point cut saves the government $88 billion on an annual basis to service that debt. Sounds like a win to me. The markets think it's a win. Unemployment rate should probably be higher if the full participation rate is really moving in a static flow going forward. Off of the April tariff tantrum, what rallied the most? The most unprofitable companies, the unprofitable companies rallied the most. So we're starting to see sort of the mega cap tech take over leadership again. So I think you're going to go high and low. You're going to go unprofitable companies. You're going to go Russell 2000 companies that are really relying on variable rate debt financing, right? 30% of them rely on this month to month, Tom.
I think we saw something to the extent of that. I believe it was from Torsten Slok over at Apollo, showing the Russell 2000 profitable versus unprofitable, and the performance gap that we've seen with the outperformance coming from the not profitable Russell 2000 smaller cap companies over the course of this kind of year, and it's been expanding. My question then, though, is we've talked about this divergence and K-shaped recovery ever since not just the pandemic, but call it the great financial crisis lows. Something has to give at some point because inflation is still a problem. It's still out there. There doesn't feel like there's a view that it could percolate up again to the levels that we saw at 4-decade highs at points over the last 3 to 4 years. But it has to still be a concern if you're a central banker thinking about a cycle of interest rate cuts. Is it not?
Correct. What would you think, though, is more of a concern now? And this is what the Fed is trying to weigh. Is it price stability or is it full employment? And at this point, we're at a juncture where it is full employment.
We're flirting with this.
The reason why I say that is the tariffs really do that one-time price shock to the price of goods. And you can't really get your head around that, right? When you think about it, tariffs are going higher. It's got to be an ongoing basis.
With this breakdown.
They stay up once. So the amount of corporations that are passing it on, that could be different. But let's think about the Budget Act that President Trump passed. People are going to get roughly per household $2,000 coming in the door
still
with
strong.
Those tax cuts.
S&P 500 still weak. Completely different
costing
story.
Them roughly $1,000 per household. You know, these are averages.
Bro.
So they're actually above water on those tax policies.
Give us our boy Rick.
So that's where I think that most of the market is not pricing in. And then the full expensing, right? So that free cash flow, net profits, those are all tailwinds to the economy. But when you look at where we're at now, look at the amount of layoffs that we've seen in the last 30 days.
Just in white-collar jobs and white-collar jobs.
Tens of thousands.
Right.
So if you're thinking, where do I want to really put my emphasis, it's on jobs right now. It's not on tariffs. We've already seen the bulk of inflation on that. I'd rather place my bets on cutting rates. And the 2-year is lower than the Fed funds rate. Does not happen often, especially in a rate-cutting cycle.
Everyone always looks for these two.
Should be above where the Fed funds rate is.
People get so
and it's
jacked
still
up.
Lower. So I think you're going to see us get back down to that neutral rate. They think it's at 375.4. I think it's at 275.3.
All right. So don't go anywhere, Steve. You're going to stick around here. We're going to talk a little bit more about this with our next guest here, a former member of the Fed's Open Market Committee, a former president of the Federal Reserve Bank of Dallas. Let's now bring into the discussion here Richard Fisher. Richard, you and I have spoken over the years at numerous times, and you've always kept a steady eye on both aspects, jobs and inflation. But inflation's always been a sticking point for a lot of folks at the Fed, you included. When it comes to the tilt of jobs versus the Fed's mandate on inflation and price stability, which do you think it should tilt more towards, given what we've seen so far?
Well, look, one of the very rare things would be to cut rates when you have 3% inflation or slightly under 3%, wherever the number is. We always want to keep 1% real rate. So this may be as far as you can push it right now, and maybe that's what the Kansas City Fed is concerned about. We'll have to see when we get a better briefing on the commentary. I think, again, every elected official, whether they're Republican or Democrat, Trump or Clinton, worries about employment. That's where the voter base is. But it is the Fed's job to have a dual mandate and to make sure we don't have inflation or deflation.
Completely different stories. Be careful.
I think, of course, you have to remember, Dom, I was a hawk. So I always worried more about the inflation side than the other side. And with regard to that, the two dissents, Myron is obviously going to do what the president wants him to. He doesn't seem to be carrying the table. You got to convince 18 other people of your argument, and he's not winning that argument. As far as Kansas City is concerned, you have to remember Tom Honig, who's one of the great leaders of that bank, was also very hawkish and voted against a lot of what we did to cut rates when I was there. So it's part of a Kansas City tradition to be on the hawkish side. I do think it's an interesting indicator. I would expect Chairman Powell in his press conference is not going to signal anything further going forward. You have an excuse with regard to the lack of data that's available. And I think the other thing to mention, I think maybe only four times in history,
why
maybe
in a second.
less.
We'll come back to
Have
this.
we ever seen a rate cut when the equity markets are rallying to this degree, being priced relative to underlying value to this degree, when the spreads are so narrow in the credit markets? So I understand why a trader is rooting for more. From the standpoint of the real economy, Rick Santelli nailed it. Rates are not going down. And businesses depend on, not on Fed funds. Businesses depend on what's happening further out the yield curve. The 10-year Treasury is the most important of all in the entire world. It hasn't moved. And Rick made the point, and I think he's right, rates have been steady through all this rate cut discussion. That's what businesses depend on. To be sure, all the Federal Reserve beige book stuff is showing a slowing of the economy. There are other data that are showing it holding up. And remember, these big layoffs that have been announced, those are important. But what really counts is what small and medium-sized businesses that don't trade in the market.
Watch these trend lines, folks. It's going to get spicy out there.
That they want. Historically, those little bitty companies that don't trade in the marketplace are the most important from an employment standpoint. They create 80% of the jobs in America. They hold roughly 50% of the jobs. So
the VIX is telling us a different story, team.
Is what's happening in the SME, small, medium sector of businesses, and not get too caught up in the big companies. It's really the smaller companies, the non-traded companies that move the economy. So you have to diverge from the economy versus what the trading market wants to see. I understand why they want lower rates. I'm a little skeptical that they're likely to get them in December, and quite skeptical, unless the economy really implodes, that they'll get more following on that. Powell has 4 more meetings after this. And I believe, knowing him as I do, he's going to hold to principle, never give in to political pressure. And Mr. Myron may have a real difficult time convincing the rest of the committee that they need to move more aggressively.
All right, so Richard,
this guy's coming
that's
off
an interesting
as
thought, Steve. I want to get
hawkish
your
as he
response to that, because Richard brings up interesting points with regard to the policy initiatives versus how the markets want things to go.
Right.
So you're the market's representative and not the central bank representative like Richard Fisher is. What exactly is your response?
I'm happy to change places with you.
No, I'm sure you are, Richard. I know you are, Richard. So, Steve, let's respond to Richard right now. Given what you said, then how he responded.
Fight him.
What exactly is the market reconciliation with the economy and some of the pros and cons that we've seen in the absence of government data?
Right. So first, let me start off with, I always love hearing Richard's comments. I always value those. That's why he's on the network, and that's why he's been around for so long.
Ruh-roh, Raggy.
If you look at, he nailed it, right? Small companies supply 80% of the hiring. Do they want higher or lower? And he said it. They would rather have lower because they rely on that variable rate fluctuation. So they need lower rates in order to hire more. So I think we have to make sure the backbone of America on a jobs front has what they need to continue the productivity that they would like to continue.
I'm seeing negative gamma
That's
beneath us.
Number 2, think about existing home sales and new home sales. New home sales, you can offer incentives. You could buy down mortgage rates. But existing home sales,
we see
you don't live in a home, you live in a mortgage.
I'm looking for a flush to 6,850
for so many years now. And that golden rate that many feel it's a golden rate is 5.5% on a 30-year fixed mortgage. We saw this during COVID. People didn't buy up as much real estate as they probably wanted to, but they did refinance a lot, and they refinanced around 3%. So we have a huge percentage that are locked in their homes. If we can lower those rates. Now, this is where it comes in to tie it all in. If you stop QT and you stop the $35 billion of MBS per month rolling off the balance sheet,
mortgage-backed securities,
that has
MBS.
the single most upward bias on 10-year yields. So if you stop that, which they are, that gives the ability for that mortgage rate to drop, hopefully precipitously. I don't know if it will be as quick as homeowners would like it to drop to get to that golden rate or below that golden rate, because that's where they'll take a leap. But I think for the economy, for homeowners, for smaller companies, Your people need lower rates to continue what they would like to do, to continue to spend money, to continue to take out debt and finance their debt. This is not only good for the average person on the street, this is good for the United States of America, that their debt financing will be tremendously cheaper the lower we go. I don't think inflation, and I appreciate Richard's comments, he's an inflation hawk, and I get where he's coming from. And he is right. I'm a market participant, but I'm well-rounding this all out. I could see both sides of this. I think to get from A to Z for the economy, for the markets, we need lower rates, and we need those rates around 3%.
All right, Richard, I want to ask you this question because as the former head of a regional Federal Reserve Bank.
All right, the real show
Dallas,
gets going
we've
in
spoken
3
a lot
minutes,
and
folks.
maybe even
Get your coffee, go to
maybe
the
not the right
bathroom,
word.
do what
We've
you need
thought a lot
to. You
about
have 3
what exactly
minutes.
policymakers are using for data in order to get the best, I guess, view possible about what the economy is doing in the absence of any government-specific data coming out of the Labor Department, of Commerce, or anywhere else. One of those things has been the use of regional Fed banks and their kind of beige book participation type data to glean a better picture of what's going on. I would like to know from you, as the former president of the Dallas Fed, just how robust is that data coming into these regional banks here, and how exactly can it be used, if effectively at all, by the central bank to help guide policy?
Well, it's not just the beige book, Dom. Every president, when they go to the meetings, which just concluded, they report what they see, what they're picking up to the minute in terms of their districts. Some districts are doing better than the others. Obviously,
getting clapped.
My former Federal Reserve District here in Dallas is one of the growth spots of America. But all of them are reporting a bit of a slowdown here. So a lot of it, again, please bear in mind, this is a judgmental business. There's no mathematical precision, despite what econometricians would like to
Econometricians?
To making monetary policy. You've got 19 people sitting around the table, best judgment from all the stimuli and what they're hearing. They would like to have reliable, gold standard official data. They don't have that right now. So they are flying in a bit of a fog.
That's a real word. Econometricians.
Complete darkness. They're getting a lot of input from the banks. They're also creating
use of statistical and
alternative
mathematical
models to understand
methods to analyze
mathematically,
economic data and create models that test economic
standpoint,
theories and make
what's going on in the
predictions.
economy.
Econometricians.
And I wouldn't say they're flying blind, but they are definitely in a bit of a fog here.
That's a good word.
The one thing I want to come back to what was commented on earlier. One of the reasons we bought up, and there's now $2 trillion in mortgage-backed securities on the balance sheet to this day, was to assist with the process of keeping those mortgage rates down when we put all that stuff on the balance sheet. And if you're going to start rolling that stuff off, it might have a negative impact in terms of mortgage rates. We'll have to watch. Here comes Powell.
Okay. No, we're going to wait just one moment here. Steve, we are waiting, as you can see here in the image, waiting for Fed Chairman Jerome Powell to take the podium. We've got roughly, call it maybe a minute 45. He's very prompt, by the way, Jerome Powell, stepping up to those podiums right now. So in the minute and 25 or 30 seconds that we have left, Steve, I'll give you a final word here. What exactly would you be wanting to listen for right now out of this press conference?
So I think a lot of these press conferences are checking the box, right? So Chair Powell.
We got to get these guys out of our ears. Folks, I'm telling you, something funky's going on. Mag 7 Delta is ripping. Half the Mag 7 reporting after the market closes today, pretty much the other half reporting tomorrow. Bullish. People are buying calls like no other, and they ain't touching puts. What's weird here is the S&P 500's at a fresh Delta low. That don't make no sense. And then when you realize the fact that Vol's holding on, dude, the market is getting ready for some frosty, froggy-like reaction. So please be ready. Please be ready. Please be ready. All right. Maybe you can hear that. Hang on. I don't want to get DMCA'd from their silly little elevator music. All right. Here we go. We're live. Can you see it? Can you hear it? Can you feel it? He's coming in. He's coming in hot. Everyone buckle up because we're going for a ride. We're going to Mexico, boys. We're going to Mexico. Get ready, get ready. Which way is it going to break? Look at that purple tie.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 3.75% to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December.
Jerome!
A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1.
Why'd he do this?
Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances.
Like this?
These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet, and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored.
Dangerous. Positive gamma
our success
above,
in delivering
gamma
on these
below.
goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country.
Watch if 50 holds or not.
Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Yo, J-Dog, he did us dirty.
Nick Timmeros, Wall Street Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So
yeah, no, we heard, brother.
That needs to be taken on board.
We fucking heard you.
You know, just say this: 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And, we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
You and some of your colleagues have framed last month and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year, where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation, and then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation. we saw a very different picture of the labor market and suggested that
we
there
got
were
into negative
higher
gamma.
downside
You are
risks to the labor
experiencing
market than we had
negative.
thought.
Watch this break
and
of
that
50.
suggested
That's where it's
that
really
policy,
turned on.
which we had been holding at a
Right
I would
here.
say modestly, other
Right
people would say
here.
moderately
Watch
restricted
this level.
needed to
If
move
that
more in the
tilts,
direction
we're
over
officially
time
in
of
negative
neutral.
gamma.
If the two goals are
This
sort
is
of
the
equally at
last
risk,
stand.
then you ought to be
50.
at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
Claire. I'm Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other. And they also have different levels of risk aversion. And, some will be more averse to inflation overruns and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when participants go out and talk, they're very disparate views, and they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, that we haven't made a decision about December. I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term debt?
That could be one of the factors, but the reality is we've seen, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at,
I feel very confident in that.
The place we're trying to reach.
What we said if you don't want. I'm just telling you now
is that
that's
when we
the last stand.
feel
this
like we're a little bit
above, and we are not on Mexico's side, brother.
Ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice. And so there's not a lot of benefit to be holding on to get the last few dollars because, again, the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Colby.
Thank you. Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second-round effects from tariffs?
Yeah, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, we do have, we get some data. The labor market is a place where we get, for example, we get the state level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings, and we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market, and the fact that we're not seeing an uptick in claims or a downtick really in openings.
It's saving itself
suggests
right
that
here.
You're seeing maybe,
this is why we haven't marked
continued
out.
very gradual
This is
cooling,
the battle.
but nothing more than
I don't
that.
know who's going to
So
win
that
it,
does
but I'm
give you
telling
some
you,
comfort.
watch this closely.
But if this shutdown lasts a while longer and you
Vol
don't
just
have
got
that data in
crushed.
hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So, we get, like I mentioned, what we get in the labor area. We get some data in inflation, some data in economic activity, and we'll have a picture of what's going on. We also will have the Beige Book again. I would say we're not going to be able to have the detailed feel of things. But I think if there were a significant or material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's, the meeting's like 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving. But we'll have to see how it unfolds.
Steve.
Steve Leisman, CNBC. Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had two dissents, one for 50 and one for no cut. So, that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet, if you stop it,
I said what I said.
Now,
That's
does that mean
quite
you
the
have
line.
to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what. In the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we'll be. We didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be. Right now, it's got a lot more duration than the outstanding universe of Treasury securities. And we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle.
Are we going to bounce out of this? This is the big test.
Janelle Marte with Bloomberg.
Will it
How
actually
are
go?
officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation. But we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments. But so directionally, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services. And we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple things to say.
Price
One is
bouncing.
that inflation away
Be
from
careful
tariffs
about this bounce.
is actually
Options
not so
do
far
not
from
agree.
our 2% goal. We estimate, people have different
But the
estimates of
SPY
what
is
that is,
turning
but
back
it might
around.
be,
That's
5 or 6.
really weird.
Tenths, and so that if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come, and it probably will increase further. But it is that it will be a one-time increase. And, we've been very focused for all of this year at making sure that that's the case and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be, a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think, we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say the first.
The stubborn services inflation that you mentioned.
Services inflation, yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And, overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just, we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market is because, the Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Great, thank you. Chris Rugaber at Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all. And could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles? How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world. Big U.S. companies
right
are
off of this zone,
just investing a lot of resources
we might
in thinking
retest,
about
we
how
might
AI,
not. I have no clue. Let's pay
which
attention.
will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that
Mag
happens
7
to
is
build
starting
data
to
centers
curl
all over the
up
country
right
is
here.
especially interest sensitive. It's based on longer run. It's longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Watch 71 on SPX and watch 160 on NQ.
Howard Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about the continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys of the Beige Book, do you worry at some point you're going to have to start making policy by anecdote?
This is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it, and that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up in the debate on this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things that we're watching very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and much of the time they're talking about AI and what it can do. So we're watching that very carefully. And yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are. If you listen to the earnings calls or the reports of, big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that
SPY is still
consumers
going up,
at the
though.
lower end are struggling
kind of
and
flat.
buying less and shifting to lower cost products, but that at the top, people are spending at the higher income and wealth. And
Watch
there's-
71 on SPX
much,
and watch
much,
160 on NQ.
Anecdotal data on that. And so we think there's something there.
Edward. Thank you. Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction of rates is not a foregone conclusion. So in December, you said far from it. So if a cut might not be on the table
what nailed the market
for
at
December
first.
because of lack of data, what does the other concerns then stem from? So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern then?
Well, the perspectives of people on the committee that, we've now moved 150 basis points, and that we're down into you're into that range between 3 and 4, where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed, the neutral rate. So, I think for some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether in fact the growth that the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, again, we've cut 50 more basis points in the last 2 meetings, and there was a sense like, let's pause here, kind of thing, and a sense from others wanting to go ahead. But that's why I say
he keeps talking about
differing
pausing
views,
right
strongly
now.
differing views.
Yeah, so on that division, then you're talking about going forward. So what's more important in this division? Is it inflation risks? Is it employment risk? Or is there a deeper philosophy division among the board?
Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices.
He's getting
We have
pissed,
differences
dude.
on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different variables, which is common through.
You could see it in the
through all
market
Federal
right when they
Reserves.
talked to him about pausing in
People just have
December. The
different
market
risk
is like
tolerances,
reacting
let's
right
say.
away
So
per word.
that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have in fact cut 2 more times, and we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes, and I'm just telling you that's what happened to me.
Watch 160.
Thank you so much. Liz Schulze with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think there are 2 things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's 2 things. That's declining labor force participation, which is a cyclical thing. And then there's declining immigration, which is just a big policy change that actually began in the last administration and it has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and the unemployment rate has gone down, meaning that demand for workers has gone down a little more than supply. So that's what's going on, but it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand? And and I would just say, when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work, is pretty close to zero.
71 on SPX.
So
Watch
maximum
this.
employment
The low
doesn't,
from
on
yesterday.
a sustainable basis, doesn't. If you're creating zero jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last two meetings, that it was appropriate for us to react by supporting demand with our rates. And we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were. And that should help so that at least the labor market doesn't get worse. Though it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools. But others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, and they've been coming into effect consistently in February, March, April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are a tenth or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think some projections go, we're at 2.8% inflation. You might get 2 or 3 more tenths or 4 more tenths maybe. But then, as all the tariffs are in, they stop generating inflation. You've had a one-time price increase. As long as you're not, at least this is the theory. This is how we believe and hope that it will work out. Once the last tariff is put on something, at that point, it becomes a higher price level, but it stops going up, if you will. Prices stop going up. They'll just be at that level, and then measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. Even, and it's nice that, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
Michael McKee from Bloomberg Television and Radio. Do you have any concerns that equity markets are or are close to being overvalued at this point?
Jesus, dude.
We don't look at any one asset price and say, hey, that's wrong. It's not our job to do that. We look at the overall financial system, and we ask whether it's stable, whether it could withstand shocks, right? So, banks are well capitalized. While some households are clearly under stress, in the aggregate, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. You don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not. It's not appropriate. We don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Witness.
Yeah, I don't think interest rates are an important part of the AI of the data center story. I think, people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about. It's not about 25 basis points here or there. We use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs, right? So we're here by lowering rates at the margin, that will support demand, and that will support more hiring, and that's why we do it. Now, no 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately, lower rates will support more demand, and that'll support hiring over time. And of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, I've told you the story. It's a complicated story, but this is the best assessment that we can make. Because there's uncertainty around inflation and the path ahead for inflation, that's why the pace we're going has been a careful one.
Victoria. Hi, Victoria Guida from Politico. On AI, I'm just wondering, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Yeah, this is different. In the sense that the companies that are so highly valued actually have earnings and stuff like that. So if you go back to the 90s and the dot-com, these were ideas rather than companies, and so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings, and it looks like they have business models and profits and that kind of thing. So it's really a different thing. The investment we're getting in equipment and all those things that go into creating data centers and feeding the AI, it's clearly one of the big sources of growth in the economy. Consumer spending also, though, has been, is much bigger than that, and has been growing, and has defied a lot of, negative forecasts, continuing to do so this year. Consumers are still spending. Now, it may be mostly higher end consumers, or maybe skewed that way. But the consumer is spending, and that's a big chunk of what's going on in the economy. Bigger than, substantially bigger than
631.84, and on IWM,
growth,
watch 246.30. That's our
growth as opposed
line.
to level. But consumer spending is a much bigger part of the economy.
And why do you think that the labor market is slowing so much, even though consumer spending is strong?
Why has it slowed so much? Well, what's happened is that the supply of workers has dropped very, very sharply due to mainly immigration, but also lower labor force participation. So, and that means there's less need for new jobs, because there isn't this flow into the pool of labor that, where people need jobs, because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of demand as well as trend. So I think you're seeing some softening. The economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown. And of course that will reverse. But you still got the economy growing at a moderate pace.
Folks, watch this trend line on all of the indices.
Hey there, Andrew Ackerman with the Washington Post. I wanted to ask if you could elaborate on how you think about policy in the context of the data drought. Does it make you inclined to stick with your plans as set out in September in the absence of the data that might change your mind, or does it make you inclined to proceed with added caution because of uncertainty?
Yeah, well, we'll know when we face that question, if we face that question. it'll probably be argued both ways, right? But I've said a couple times here that, if you really aren't getting information you really don't know, and the economy looks like it's solid and stable and hasn't really changed, there will be an argument. I don't know how persuasive it will be, but there will be an argument that, you slow down when you can't see as far ahead. Others may argue, I'm not sure where this argument will come up, but you're perfectly right that you could also argue, well, things haven't really changed, but you might not know that, So I don't know whether we'll face this or not. I hope we don't. I hope by the time of the December meeting we're getting, a better flow of data. But if we're going to have to do our jobs one way or the other.
Okay. I also just wanted to ask a FinReg question. I think several years ago you said the overall amount of capital in the system was about right. As the Fed moves forward with a revised Basel proposal, potentially changes to the GSIB surcharge, has that changed at all? Or are you planning to significantly reduce the amount of capital in the system? Thanks.
So there are discussions going on, I think, among the agencies, and I don't want to get ahead of those discussions. I continue to think that the level of capital, when I said that in 2020, was about right. And of course, there's been much capital added since then through various mechanisms. But I look forward to. I know those discussions are really just getting going. They haven't come to the point where they're got a whole plan and that kind of thing. So I really don't have much to say on that.
Brian.
Hi, Chairman Powell. Brian Chung with NBC News. Is the weakness in the jobs market accelerating, and who's at risk if the interest rate cuts are not the effective medicine for a further slowdown in the labor market?
So we do not see the weakness, as you put it, the weakness in the job market accelerating. I would say, then again, we didn't get the September employment report, payroll report, but we look at, the unemployment insurance claims, initial claims are reported at the state level, and we still get those, and we can accumulate them and get the national number. And there's really, there's no story. You can look at the numbers. Same thing with the job openings we get from Indeed. There's just no story over the last 4 weeks. It's kind of stable. So you don't see anything that says that the job market is, or really any part of the economy is making a significant deterioration. Don't see that. You see more things like I mentioned.
The trend line on SPX.
You see big companies making announcements of either of layoffs or of the idea that they won't need to hire. Their number of employees is not expected to go up over a number of years. There may be different people working there. They say that too, but they don't need a bigger head count. So you see those kinds of things. You don't see it in the aggregate numbers. The layoff numbers have not gone up, but job creation is very low, and the job finding rate for people who are unemployed is very low. But the unemployment rate is very low as well. 4.3% is a low unemployment rate.
So as you make these cuts, is it the lower income workers that you're thinking about, or those who might have their jobs automated? Is there a particular section of the labor market that you're particularly?
So we can't, our tools don't allow us to target any demographic or any income level and that kind of thing. I do think that people, we saw this during the global financial crisis and the long recovery. If you have a long period of very strong labor market conditions, it benefits people at the lower end the most. The last 2 or 3 years of that long expansion, people at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically, which were very constructive. And we're not at that place right now. But so, a stronger labor market is the best thing we can do for the public. It's also part of our job.
All three.
It is half of our job.
SPY, Qs,
but it is absolutely the best thing we can do for people.
Are there enough
along
dip
with keeping
buyers?
Prices stable? Those two things. Inflation also hurts people on fixed incomes more than other people.
There's the dip buyers right there. Wow.
Hi, Chair Powell. Courtney Brown from
Look how
Axios.
thin this book is.
As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider those reappointments and whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. The way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them. We're in the middle of that process, and we're going to complete it in a timely way. And that's really all I can say.
This is 26,100. Oh, just got pulled and moved up to 190, and they just took him out.
Daniel Davis, Agence France Presse. You've now had dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions, and you've just mentioned there's strong disagreement over the future path of rate cuts. Have these disagreements complicated your role presiding over the FOMC meetings, and if so, how?
I wouldn't say that, no. I think you have to take what comes, and what comes right now is pretty challenging situation where we have, first of all, we have 4.3% unemployment. We have an economy that's growing close to 2%. So, overall, it's a good picture. It's a good picture. But in terms of our policy, we have upside risks to inflation, downside risks to employment, and this is a very difficult thing for a central bank because, one of those calls for rates to be lower, one calls for rates to be higher. We can't do both, so we have to balance the two. And so it's a challenging thing, and as we have worked our way through this process, you would expect that there would be a range of views across the committee on what to do and the speed with which we should do it. And that's what we have. That makes a lot of sense to me. All of these people are, people who take their jobs very seriously, work very hard
down
at
here
this,
is 160.
just want to do
That
what's
same
right for
line
the
we've been
American
calling
people,
out
but they have
for a
different
while.
views on what that is.
That's where the sitting
And,
buy orders are. On
it's an honor to work among people who care that much.
Sell orders at
It is,
10,
but
15, and 20.
I don't feel that it's unfair or anything like that. It's a time when we're making quite difficult judgments in real time, and I believe we'll get through this. And I think we've done sort of the right thing so far this year. I think it was appropriate for us to be careful about this. I think it would not be appropriate to just ignore or assume away the inflation issue. At the same time, I think the risk of higher, more persistent inflation has declined significantly since April. And if we do wind up resuming rate cuts at some point, we will. At some point.
Oh, they just rip through that.
I think we're trying to get to the end of this cycle
Rip through that.
with the labor market in a good place and with inflation, on its way to 2% or at 2%. So that's all we're trying to do.
Save this
and we're doing
trend
it
line
under
right here
quite challenging
that we just
circumstances
tested.
and doing the best we can.
We'll go to Jennifer for the last question.
All right, almost done.
Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Both regional and large banks have taken losses on loans given delinquencies on subprime auto loans. JP Morgan CEO Jamie Dimon warned, when you see one cockroach, there may be more likely. I'm curious how the Fed is looking at these loan losses and if it poses risks to the financial system or the outlook for the economy. Is it a warning sign?
So, we're obviously we watch these things very carefully, credit conditions very carefully. You're right. You've seen rising defaults in subprime credit for some time now, and now you've seen a number of subprime credit, automobile credit institutions having significant losses, and some of those losses are now showing up on the books of banks. We're looking at it carefully. We're paying close attention. I don't see at this point a broader credit issue. It doesn't seem to be something that has very broad application across financial institutions, but we're going to be monitoring this quite carefully and making sure that is the case.
And then separately, many, you yourself have said that we're in a bifurcated economy right now with high net worth individuals continuing to spend with the lower income pulling back. How much of consumer spending continuing hinges on the stock market remaining strong? In some odd way, does the market help keep the economy buoyant?
So there is some
100%.
There's some relationship there, but remember, the more wealth someone has, the lower an additional dollar of wealth matters. So your marginal propensity to consume declines quite dramatically as you reach levels of stock market wealth. So, the stock market. It would affect spending if the stock market went down, but it wouldn't drop. It wouldn't drop sharply unless there were quite a sharp drop in the, in the stock market. People at the lower end of income and wealth have a much higher marginal propensity to consume of an incremental dollar of income or wealth, but they don't have the stock market wealth. So I think it's certainly a factor supporting consumption right now. But you would see it if you saw a material correction in spending, but it wouldn't be. You shouldn't think that it'll dollar for dollar stop consumption, because that wouldn't be the case. Thanks very much.
Is that it? Wow. Well, hang on. Let me get rid of this so we don't get DMCA. Let me drop that. Let me drop this. All right, that is cooked. All right, let me just double check that is removed from everything. Okay. Well, we violently went nowhere. Here is the picture on the situation. Let me clean it up a little bit just because I know there's a lot of lines on this chart. We went to the major test level. I called out 850 before the market even opened today. We talked about it quite a bit this morning. It had a lot to do with the iron condor. I could show it to you right here. This is how we knew it was a key level, key gamma level, also psychological level. So it wasn't some big brain play by any means, but it was 6,850. It was a very evident one. And guess where we bounced? 6,851. Like right here was the bounce at 2:41 p.m. and we bounced off of it and then just got range bound right below yesterday's closing value. So we're not holding 6,900. That's not the end of the world, but obviously the bulls would like it above 6,900. But still, still decent. And the bears very much wanted it below 6,850, and that obviously did not happen. We actually had a very strong bounce off of it. So I would say the bears today are upset. Their only thing that they could point to is, hey, we cracked yesterday's low. But even that, on the second test, they bounced right off of yesterday's low. So today, I know this doesn't feel good, but when you look at the daily chart, you're going to realize overall things are still very, very bullish. Yes, we cracked yesterday's low, but we didn't really make the most effort to hit the gap fill. So this basically sets us up in a way where it makes it tough to do anything in all reality. This wasn't a dominantly bearish day where we crack key levels and you want to go out and buy protection below 6,850 because we just didn't crack it. But on the flip side, you don't want to kick it long because call skews are way too, they're way too much. If you're chasing on calls right now, you're basically just overpaying that. They're if you watch the spot gamma thing this morning, you're paying a 99 percentile value to get into calls. So we're not really seeing exactly what you need to be comfortable to be short here, especially because if the earnings are good. Don't forget, Trump is speaking with President Xi of China and South Korea at 10 p.m. Eastern tonight. So right now, we just have a bunch of mixed signals. You really do. It's if you already have a position that's decently up, ride the trend. Whatever trend you're riding, try to ride it. Set a stop to break even. I get it. But to create, if your question is to create a new position like now, I just don't know what the case is. I really don't know what it is. I mean, we're seeing just calls are way too rich, and to get into puts, I guess you could buy some protective puts, maybe, but I don't even know if that's the most compelling case right now. This is a situation of sit on your hands. Excuse me. But we are at that point where my voice is starting to go. Before I let you go, you only have a couple days left to take advantage of the Funded Futures Network deal. 50% off evals. When you buy one, you get one. So for 50% off, you get two. And there's no activation fee. Use that code Goonie. It's only for the remainder of this week. Pinned to the top of chat in the description of the video. Other than that, we'll be streaming once again tomorrow morning, 9 a.m. bright and early. Between now and then, there is a lot going down. So between now and the next time I see you, you got the market's going to get a little bit nutty. After the market closes today, we're going to get the earnings report from Meta, Microsoft, and Alphabet, aka Google. Tomorrow morning, Eli Lilly, which just had the announcement with NVIDIA. And then after the market closes tomorrow, Amazon and Apple and Coinbase and Reddit and MicroStrategy. On top of that, at 10 p.m. Eastern, that's going to be the scheduled meeting between President Trump and President Xi. So basically, the next 36 hours are going to be pretty nuts. And then I also want to remind you, in terms of major macroeconomic announcements, later on this week. We have the GDP report tomorrow morning, 8:30 a.m., an hour before the market opens. And then Friday, to finish up the week and the month, we have the inflation report, the PCE inflation report. Once again, that is going to be an hour before the market opens. So really, between this moment and tomorrow before I see you, there's a lot going down. But also between now and just the remainder of the week, there's a lot of things. So pay attention to the VIX. The VIX is looking a little bit strong right now. So that would be concerning if I were a bull. Price action itself is holding. We're range bound. We're not really breaking one way or the other. The Russell is looking weak. So on a relative basis, the SPY's in the middle, the Russell's the weakest, and the Qs are the strongest, but they all took a hit. But the Qs are still green relative to yesterday. The SPY is red, and the Russell is down. Oh, it's down 1%. That one's definitely red on the day. Folks, it goes this way. Yesterday, even though we hit new all-time highs, this is a really rare circumstance in which we are at record highs and gapping up and gapping up and gapping up, but only because of a few equities. The breath yesterday was the worst breath we have ever had. So what does that mean for you in layman's terms? It means literally only a couple of stocks are the reason why we are going up. So if those couple of stocks keep doing well, yeah, the party's going to continue. However, if one of these stock, and really it's the Mag 7, if they start to falter, if the semiconductor AI play has a hiccup because of earnings, major macroeconomic development, or maybe Xi and Trump don't kiss and make up, well, then the party's over, at least in the short term. Of course, in the long term, you should always be a perma bull, but I'm talking about what to pay attention to for the next couple of days, the next couple of weeks. Please understand, this entire market rally is only because of a couple stocks. So if those stocks falter, we have an issue. If they keep going, the party's still on. So please pay attention to that. Please pay attention to that. Obviously, pay attention to the earnings tonight, the president talk tonight, and also the GDP report tomorrow morning. I will be streaming tomorrow morning as well. And other than that, I just need you guys to know, as you put your head on the pillow to go to sleep tonight, I deeply, deeply love every single one of you. So from me to you, a little kiss on your forehead tonight. Thank you so much for the good vibes. I'll catch you tomorrow. You guys are all beautiful motherfuckers. Peace out. Later.